Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at FuelCell Energy.
If you find our talks useful, please consider subscribe, like, and comment underneath.
So, right now there is this massive kind of hidden bottleneck happening in the whole AI revolution.
Yeah, and it's not a shortage of silicon chips, right? I mean, it's not a lack of software engineers either. It is literally just they are running out of electricity.
Exactly. The traditional U.S. power grid simply cannot handle the sheer scale of what these new AI data centers require.
It's crazy. And today we're looking at how this panic, really, for off-grid power has taken a previously ignored energy stock, FuelCell Energy, and just turned it into an explosive, highly volatile battleground.
It really is a battleground right now.
Right, so we're going to unpack whether this is just, a fleeting surge built purely on AI hype, or if we're looking at a structural shift in how the internet's infrastructure is actually powered.
Because the numbers we're seeing right now, they're just staggering. I mean, data centers used to be just these large warehouses of hard drives,
Yeah.
But AI data centers are more like heavy industrial foundries.
Yeah, the power draw is insane.
They consume gigawatts of power. And the realization that the grid cannot save them is what's forcing this massive pivot toward on-site distributed power.
Which is exactly what sparked that massive recent rally in fuel cell energy. I mean, we are talking about a 67% weekly surge.
Which is wild.
It is. And, before we really pull apart the mechanics of their technology and the cash burn and all of that, I do want to address that kind of volatility up front.
Yeah, that's important.
Because when a stock moves 67% in a matter of days, it is incredibly easy for your emotions to just completely take over. You see that giant green candle and the FOMO kicks in hard.
Oh, absolutely.
And that is actually why having clean, objective visual data is so critical. And it's why we want to mention VIP Algos here. It's this TradingView indicator suite, and it's basically designed to help you read charts more clearly.
Right. It gives you those visual buy and sell alerts, trend direction tools, support and resistance zones, areas to actually plan your take profits and stop losses.
Exactly. It helps strip the emotion right out of the equation.
Okay.
And you can use it across multiple markets, stocks, Forex, crypto, you name it. We put the link below in the description for you to check it out.
But we always have to be crystal clear about this. It is an affiliate link, meaning we may earn a commission at no extra cost to you.
Which does help support the show.
Yes, it does. But, VIP Algos is an educational chart analysis tool only. It is not financial advice. It does not place trades for you, and it absolutely does not guarantee profits.
Right. Trading inherently involves risk, so you always have to manage that risk and do your own research.
Always. So let's get into the wealth building context here. If you are looking at your portfolio, it's vital to know exactly what kind of animal you're dealing with,
Yeah, and FuelCell Energy is not some sleepy, safe utility stock that's going to pay you a steady 4% dividend while you ignore it for 20 years.
Definitely not. This is what we call a high beta turnaround play.
Right. And just to clarify, for anyone who hasn't encountered that term, high data essentially means it moves with far more extreme volatility than the broader market.
Like an amplifier.
Exactly. If the S&P 500 goes up 1%, a high beta stock might jump 4%. But if the market drops, it amplifies the fall on the way down too.
So it's a speculative play on a very specific multi-year trend. Basically, the thesis that AI data centers will absolutely require off-grid power to function.
But that's the central question here, right? Is this just a short-term momentum trade? I mean, are investors just buying it because it's tangentially related to the AI buzzword?
Right, the AI halo effect.
Yeah, or is this technology actually a legitimate foundational block for a growth portfolio over the next decade? Let's start with the reality of the business today versus what Wall Street thinks it's going to be tomorrow.
Well, the gap between today's reality and tomorrow's projection is, it's massive. If you look at the most recent quarter, the second quarter of fiscal 2026, revenue came in at $35.6 million.
Okay.
Which is actually a 5% year-over-year decline.
Wait, hold on. They're at the center of an AI power boom and their revenue is shrinking. Why?
Yeah, I know it sounds counterintuitive. It largely came down to fewer module exchanges in the quarter and lower output at one of their specific projects.
Module exchanges.
Right, so a module exchange happens because fuel cells naturally degrade over time. The core modules need to be physically swapped out to maintain efficiency.
Got it.
So it's lumpy revenue. It doesn't happen evenly every single quarter.
That makes sense.
But the market clearly doesn't care about a 5% dip today because they are entirely focused on the aggressive growth projections. Analysts are currently forecasting FuelCell's revenue to jump from about $158.1 million in fiscal 2025
Okay.
to a staggering $1.1 billion by fiscal 2030.
Wow. I mean, going from 158 million to over a billion, that is a massive leap of faith. And when you look at profitability right now, it paints a much more cautious picture. Like the Q2 GAAP net loss was $77.6 million.
Yes, but context is super critical on that number. That $77.6 million loss included a $42.6 million one-time non-cash charge.
Oh,
It
okay.
was tied to a project at a U.S. Navy submarine base.
Okay, let's translate that real quick. A non-cash charge means they didn't actually write a check for $42 million out of their bank account this quarter, right?
Exactly.
It's just an accounting adjustment, like maybe writing down the value of an asset or adjusting a liability on paper.
Spot on. It's an accounting reality, but it doesn't impact their day-to-day liquidity in the same way.
Mm.
If you strip that one-time charge out, their adjusted EBITDA loss,
Which is basically their operating loss before interest, taxes, depreciation, and amortization.
right, that adjusted loss actually narrowed by 12% down to $17.1 million. So the core operational efficiency is slowly improving.
That's a huge distinction. And looking at the balance sheet, they seem to have some immediate runway. They ended the quarter with $441 million in cash. And outside of specific project financing, they are largely debt-free. Plus, they're sitting on a massive $1.14 billion order book.
Which is great.
It is. But to me, the financials only really matter if the underlying product is fundamentally better than the competition. Like, why fuel cell energy? If I'm building a billion-dollar data center, why don't I just buy a field of solar panels or a massive row of diesel generators? What's the moat?
It all comes down to the underlying engineering of their proprietary molten carbonate fuel cell technology,
No.
or MCFC.
MCFC, okay.
The absolute key advantage here is that this technology generates direct current, or DC, power natively.
Okay, this is where the engineering actually dictates the economics. Let's unpack this for a second. The traditional power grid, the poles and wires outside your house, operates on alternating current, AC.
Right.
And AC is fantastic for transmitting power over long distances. But AI data center servers, the actual computer chips doing the math run on direct current, DC. So traditionally, you pull AC power from the grid, and you run it through a massive inverter to convert it into DC power for the servers.
And that conversion process is the enemy of efficiency.
Exactly. Think of it like a leaky water hose adapter. Every single time you force that electrical current to change formats from AC to DC, you lose energy in the form of heat.
You lose pressure.
Right. When you're running a 100-megawatt data center, those conversion losses cost millions of dollars. And they require massive air conditioning systems just to cool down the heat generated by the conversion itself.
It's horribly inefficient. So what the molten carbonate fuel cell does is plug the AI data center directly into the power source natively in DC.
No conversion.
Right. There is no AC to DC conversion step. There's no leaky adapter. You completely eliminate those conversion losses, which vastly improves a metric the industry obsesses over called PUE, or power usage effectiveness.
So by generating DC power directly on site, they are practically custom built for these server farms. But what about the diesel generator alternative? You see those behind every hospital and data center right now.
Well, diesel generators are great for emergency backup for a few hours. They are terrible for primary, always-on power.
Expensive to run.
Expensive, and first of all, they are incredibly noisy. And second, they produce heavy air emissions.
Right.
If you're a tech giant trying to build a massive new AI campus near a suburban area,
Oh, right.
community permitting is a nightmare if you plan to run industrial diesel engines 24/7. Fuel cell energy systems run quietly and produce drastically lower emissions. It bypasses a huge amount of friction with local governments.
And to scale that up, they're rolling out a new standardized 12.5 megawatt energy block in 2026, basically making these deployments modular and highly repeatable.
Which is exactly what the industry needs right now.
Yeah.
But having superior, clean, DC native technology only gets you so far in the lab.
Yeah.
The stock market needs real-world events to trigger momentum.
The catalyst.
Exactly.
Yeah.
Which brings us to their catalysts. The absolute lifeline for this company right now is a massive 380-megawatt framework agreement with a company called Fit Energy USA.
Wow.
And it's specifically designed to power AI data centers.
Just to give you a sense of scale, 380 megawatts is monstrous. A standard large data center might use 20 or 30 megawatts. So this agreement represents the kind of enterprise-level scale that validates FuelCell's technology to the rest of the market.
And it's not just private enterprise throwing their weight around. We're also seeing significant backing at the federal level.
Really?
Yeah, the Export-Import Bank of the United States, or XM, just approved a $49 million non-dilutive financing package for them.
Oh, man. That phrase non-dilutive is music to an investor's ears. It means the company is securing capital without having to issue new shares, so your slice of the company pie doesn't get smaller.
Exactly. And looking at the immediate timeline, the next 3 months are packed with catalysts. In September, we have their Q3 fiscal 2026 earnings. The market is going to be hyper-focused on any updates regarding this massive 4-gigawatt pipeline they've been talking about. And specifically, they're looking for progress on the initial 30-megawatt tranche of that FIT Energy deal.
Right, proving that it's actually moving forward.
Exactly. Then in October, the second tranche of that XM financing is expected to close.
And if we look just a bit further out to late October 2026, management has drawn a line in the sand. They are targeting a 100-megawatt annualized production run rate at their manufacturing plant in Torrington.
Yes.
And they've explicitly stated that crossing that 100-megawatt threshold is the mathematical key to finally reaching positive adjusted EBITDA.
And all of this operational momentum is being supercharged by a massive macro tailwind, which is the U.S. grid interconnection queue.
Oh, the backlog.
Right. Right now, across the United States, the wait times to physically connect a new massive power project to the grid are severely backlogged.
It's like a massive traffic jam at a single toll booth. You can have the money, you can have the land, you can have the servers ready to go. But if the local utility tells you it'll take 4 years to upgrade the transmission lines to bring you the power you need, your AI project is dead in the water.
It's completely stuck.
The grid simply wasn't built for this kind of localized, intense draw. And this grid failure is exactly what forces infrastructure companies to adopt on-site power like FuelCell.
And the market suddenly woke up to this reality. Which brings us to the price action on the chart. Because the behavior here has been nothing short of explosive.
Yeah, let's talk technicals.
We saw the stock surge 24% on June 29th. The very next day, it jumped another 21%.
Just massive back-to-back days.
Exactly. That created a massive 67% weekly rally, driving shares straight to 52-week highs, hitting right around $22.77.
But as anyone who trades volatility knows, structure matters, right? A stock doesn't just go up in a straight line forever. We saw a very predictable short-term pullback on July 2nd as traders naturally took profits off the table after a 67% run.
Right.
And right now, the stock is testing major resistance right at the mean analyst price target of $22.86. If it can break through that technical ceiling, the street high target sits all the way up at $32.
And the most telling part of that rally wasn't just the percentage gain, it was the volume.
Yeah.
The move happened on extremely high volume, meaning this wasn't just retail traders hyping it up on a message board.
Right.
There were active institutional whale alerts flashing on June 30th and July 3rd. That points to serious institutional accumulation and speculative options flow.
And when Wall Street institutions start pouring in, you usually see the analyst ratings shift to follow the money.
Which is exactly what we're seeing on the sentiment side. The mood on Wall Street has shifted from highly polarized to outright bullish in certain corners.
Yeah, B. Riley recently upgraded the stock from neutral to buy. They're the ones who set that street high $32 target. And their thesis is basically based on forecasting positive EBITDA generation by the second half of 2027.
And Jefferies also upgraded the stock. Overall, out of 9 major analysts covering it, you currently have 3 rating it a strong buy, 4 at hold, and 2 stubbornly maintaining a strong sell.
So the debate isn't entirely over, but the momentum is decidedly upward.
Definitely.
There's also a really fascinating speculative element happening under the surface regarding the Russell Index's semi-annual reconstitution.
Oh, this is crucial to understand. Index funds, like the ones tracking the Russell 2000, they don't buy stocks based on emotion or even fundamentals. They buy strictly based on market capitalization rules.
Right, algorithms just following the rules.
Exactly. Because FuelCell just had this massive sudden surge in its market cap. There's a strong rumor that it could push into a higher weighting within those indexes during the reconstitution.
And if that happens, it triggers mandatory passive fund purchases. The algorithms that manage those massive ETFs will simply be forced to buy millions of shares of FuelCell stock indiscriminately just to match the new index weightings.
Yeah.
That can create an incredible technical tailwind for the price, regardless of what the company actually accomplishes that week. But I have to push back on all of this bullishness for a second.
Okay, let's hear it.
Are we putting the cart before the horse here? Are investors pricing in 2030 revenue projections today simply because the letters A and I are attached to the headline?
You are completely right to question that. And it transitions us perfectly into the risks and the primary bear case. Because while the technology is great and the macro story is perfect, the financial reality of getting to 2030 is brutal.
It usually is with turnaround plays.
The biggest threat to anyone buying this stock today is the dilution problem. Management is projecting a $500 million free cash outflow between now and 2030.
500 million.
Yes, they're going to burn $500 million to build this future.
And since they only have 441 million in the bank right now, they have to find that money somewhere. And how do they usually find it?
By using an at-the-market or ATM equity program.
We really need to explain how an ATM program actually works because it is the silent killer of stock portfolios. When a company uses an at-the-market facility, they are continuously creating brand new shares out of thin air and selling them directly into the open stock market at whatever the current price is.
And in the second quarter alone, FuelCell raised $155.3 million in net proceeds through this exact program.
Wow.
The result of that capital raise. An 82.85% year-over-year increase in their total shares outstanding.
So think about the business as a large pizza. Last year, that pizza was cut into 100 slices, and you own one of them. Over the last 12 months, the company used their ATM program to cut that exact same pizza into 182 slices.
Right.
The pizza didn't magically get 82% bigger today. Your slice just got drastically smaller. That kind of heavy, relentless dilution acts like a massive gravitational pull on the stock price.
It really does.
Even if revenue is increasing, even if the underlying business is technically growing, the value of a single share struggles to rise because the supply of shares is just constantly flooding the market.
A race against the clock. Can they scale revenue fast enough to outpace the rate at which they're printing new shares? And beyond the dilution, you have significant execution and counterparty risk.
Oh, right, the FIT Energy deal.
Yeah. We talked about that headline 380 megawatt deal. It is important to note that the agreement is for up to 380 megawatts.
Ah.
It is a framework. It's not a fully funded, guaranteed, immediate purchase.
And building physical energy infrastructure is notoriously slow. You have to acquire land, secure massive project financing, get environmental permits, and, actually build the modules.
It takes forever.
These construction cycles can take anywhere from 18 months to over 3 years before a single dollar of actual revenue is recognized on FuelCell's income statement.
Plus, you have to factor in the counterparty risk. Does FIT Energy actually have the capability, the credit rating, and the capital to fulfill their end of a multi-year, multi-$100 million framework agreement?
Right. If that deal falls through or even just gets significantly delayed, the 2030 projections collapse and the cash burn becomes fatal.
Exactly.
So with all the technology advantages on one side and the heavy dilution risks on the other, what is the final verdict on FuelCell Energy?
The bullish score lands at a 7 out of 10. The investment stance here is that this is a quintessential high-risk, high-reward turnaround play.
Okay.
The ideal target horizon, if you're stepping in, is a 12 to 18-month hold. You're specifically looking to capture the upcoming catalyst of the initial 30-megawatt deliveries to FIT Energy and the finalization of the EXIM financing tranches.
That makes sense.
To summarize the thesis, the structural shift toward off-grid data center power is very real. The U.S. grid is failing AI. FuelCell's native DC output technology is practically a tailor-made fit for the problem. But it is a dangerous race against cash burn and share dilution.
And of course, as a reminder to you listening, this analysis is strictly for informational purposes and is not financial advice.
Right.
And speaking of managing risk in highly volatile setups like this, if you are looking for a cleaner way to analyze the technical structure of a stock, definitely check out VIP Algos through the link below in the description.
Yeah, it's a really helpful TradingView indicator suite.
It really is. Featuring visual buy and sell alerts, trend direction tools, and support and resistance zones to help you plan your take profits and stop losses. It makes scanning charts significantly easier, but remember, it is just an educational tool.
Always do your own research.
Exactly. It's not financial advice, it does not place trades, and it does not guarantee results. Trading involves risk. And again, that link is an affiliate link, meaning we may earn a commission at no extra cost to you.
Before we wrap up, I want to leave you with this final thought. We are watching tech giants pour hundreds of billions of dollars into AI, software, and language models, right?
Oh, yeah. Massive amounts of money.
But If physical electricity becomes the ultimate unbreakable bottleneck for the entire AI revolution, will the companies building the energy infrastructure ultimately capture more reliable long-term value than the software companies themselves?
That is a fascinating question.
Think about that. And if this analysis helped you connect the dots today, please subscribe, like, and comment underneath. We'll see you in the next one.